You may have heard that dividends are taxed twice. You may have also heard that capital gains are taxed twice. This video explains the double taxation of dividends and why some argue there is double taxation of capital gains. Okay, so let's start with dividends. When a corporation makes a profit, it can distribute a portion of that profit in the form of a dividend. Corporations must pay taxes on their earnings, which are used to pay the dividends. Shareholders must also pay taxes on the dividend income they receive, resulting in double taxation. At this point, you may be thinking, shareholders aren't paying the corporate tax, right? They just pay the tax on the income they receive from the corporations in which they invest. Well, let's think about what it means to be a shareholder. When you purchase shares in a corporation, you actually own part of the corporation. So when the corporation is taxed, the money it pays to the government is coming out of the potential return on your investment. Then when you get a dividend, which is one component of the return on your investment, it's taxed again. Consider this example. Michael, George, and Job run a successful frozen banana stand. They pool their resources to buy the stand itself, the permit to sell frozen bananas, and all the supplies they'll need. They mark up the price of frozen bananas and make a profit. In fact, on a particularly good day, they make a profit of $1,000. Now the government first comes to the banana stand and imposes a 10% effective tax on the business. The owners take $100 out of their $1,000 in profit and hand it to the tax collector. $900 remains, and each owner takes home $300. That night, the tax collector goes to each owner's house and imposes a 15% tax on the income they received from the frozen banana stand. Each owner gives the tax collector $45, leaving them each with $255. Now consider what would have happened if the business hadn't been taxed. Each owner would have taken home $333.33, since that is a third of the $1,000 in profit they made. The tax collector would take 15%, which comes out to $50. This leaves each owner with $283.33. So if the business hadn't been taxed, each owner would have kept $28.33 more in profit. That's how the double taxation of dividends impacts shareholders. Now, I wanted to demonstrate in our example how corporate taxes impact shareholders, but the more common argument for resolving the double taxation of dividends is to eliminate the tax on dividend income. Applying this approach to our example, the business would pay $100 in taxes and each owner would take home $300. Since they already paid taxes at the business level, they're done. Okay, what about capital gains? Well, capital gains result when the current price of an investment is higher than the purchase price. So are capital gains also double taxed? Some would argue that they are. The logic here is that when corporations make a profit, the price of shares of that corporation rise. The corporation is taxed on their profits, and the investor is taxed on the capital gains that resulted from those profits. The problem with this argument is that a corporation's share price is determined by many factors, not just current profits. Consider the following example. A biotech company is rumored to be developing a new drug that will instantly cure the common cold. The share price of the company rises 25% and investors sell. They just received a large capital gain that had nothing to do with the corporation's current profitability. If the drug is later approved and works, this company will likely be very profitable. But the corporation isn't being taxed on anything related to the news, only on their current profits. So that's dividends, capital gains, and double taxation. Thanks for watching.